Why are you broke? And also peep the voiceover because somebody forgot to talk during this. So today let's talk about how to peep the actual value of a company while I make a coconut jello pie. Yay! Okay, first things first, it is important to understand a company valuation because valuation helps you understand if a company's stock is overvalued, undervalued, or fairly priced. Investing in undervalued stocks can lead to higher returns, while avoiding overvalued stocks can prevent losses. Also, do not use expired milk for this pie. You will regret it. When evaluating a company, you need to understand the price to earnings ratio. Pretty much what this is that it compares a company's stock price to its earnings share. Think of it as how much you're paying for each dollar the company earns. The formula is super simple. It's market price per share over earnings price per share. A high PE ratio means that the value of stock is overpriced, or it could mean that investors expect big growth, while a low PE ratio might indicate a bargain or potential trouble. Let's say that company A has a stock price of $100 and an earnings per share price of $5. And then let's say that company B, on the other hand, has a stock price of $50 and an earnings per share of $5. So the PE ratio for company A is 100 divided by 5, which gets you 20. Whereas the PE ratio for B is 50 divided by 5, which gets you 10. Company A has a higher PE ratio, suggesting higher growth expectations compared to company B. Another thing to think about is the price to book ratio. The PB ratio compares a company's market value to its book value, which is the net asset value. It's like seeing if a company's assets are worth the stock price. Pretty much, the formula takes market price per share divided by book value per share. A lower valuation or PB ratio means that the stock is undervalued, whereas a higher PB ratio might suggest an overvaluation or valuable intangible assets. Make sure to add them nuts, by the way. To calculate this, let's say that we have company C and their stock price is $80 while their book value per share is $40. You basically divide the 80 by the 40 and it gets you 2, which is their PB ratio. Another thing that you have to consider is the dividend yield. The dividend yield shows how much a company pays out in dividends each year relative to its stock price. Think of it as a return on investment in forms of future cash payments. To calculate this, you're dividing the annual dividends per share by the price per share. A high dividend yield might be great for income, while a lower yield could indicate the company is reinvesting profits for growth. Let's say that we have company D. Let's say that their annual dividends is...
The nuts are wet! the nuts are actually wet! Wild!
$4 and their stock price is $100, you're going to take the 4 over the 100, which will get you around 4% for dividend yield.
I grinded them. I grinded the nuts. But now they look so moist. I have moist nuts.
There are plenty of tools and resources that can help you with this stuff. Think about financial websites. We have examples of Investopedia, the Motley Fool, Yahoo Finance, the Wall Street Journal. We can also talk about looking into up-to-date financial news, stock quotes, and basic financial radios for the companies. There are also stock market apps, think like Robinhood, E-Trade, the Yahoo Finance app. They offer real-time stock quotes, financial ratios, and news updates. Some apps even offer educational content. Due to my traumatic experience in accounting, I learned about company financial reports.
Take your wet nuts. Take your wet grinded nuts into the pan and press them around. Smush, smash the nuts into the pan.
Every company that is public is required by the SEC to release a public statement about their company financials. Company websites, usually under investor relations, is where you can find them, or you can even look it up on the SEC's Edgar database. And they also offer typically a detailed financial statement with annual reports and earnings reports. Guys, these things are like 80 pages of pure information on this stuff. I cannot stress how much the modern world has made finance easier for everyone. Think about financial calculators. Like, you can find free online PE calculator ratios or even dividend yield calculators, or you can buy a financial calculator and then watch a video on YouTube on how to calculate these fun little finance equations. Babes, you can find it, and I believe in you. They are easy to use tools used to calculate financial ratios, and they make them simple by utilizing simple inputs. It's why frat men are able to pass finance. Another thing you can do is do the discounted cash flow analysis. Basically what this does is it estimates the value of a company based on its expected future cash flows discounted back to their present value. It's like figuring out how much money a company is worth in today's dollars. This method provides a detailed look at a company's potential profitability, and it's particularly useful for long-term investments. Guys, there are online calculators, but the basic way to calculate it is you have to estimate the company's future cash flows for a certain period, think like 5 to 10 years. Then you need to determine the discount rate, often the company's weighted average cost of capital, or the WACC. And then you have to calculate the present value of these future cash flows Finally, you have to sum the present values to get the total value of the company. You can also look into calculating the enterprise value. EV measures a company's total value, including debt and excluding cash. It provides a more accurate valuation by considering the company's capital structure. The formula is pretty much the market capitalization plus the total debt minus the cash and cash equivalents. This type of formula is super useful when comparing companies with different capital structures, such as high debt versus low debt. Another way to really help calculate value is by utilizing the earnings before interest, taxes, depreciation, and amortization formula. Basically, this measures a company's overall financial performance, and it is often used as an alternative to net income. This metric strips out non-operational expenses to give a clearer picture of operational profitability. When doing this, always consider financial modeling tools, thinking Excel or Google Sheets. There are templates that perform DCF analysis and other financial models to help you better visualize this. Make sure you're always researching your investments. Think like Morningstar, Bloomberg, or S&P Capital IQ, even the Wall Street Journal. They offer detailed financial data, analyst reports, and valuation tools. There are also lots of good online courses. You can find them on Coursera, Udemy, and even Khan Academy has them. Courses on financial modeling, valuation techniques, and investment analysis seriously help. And there are books on valuation. There's like Valuation, Measuring and Managing of the Value of Companies by McKinsey & Company, or The Intelligent Investor by Benjamin Graham. They offer in-depth knowledge and practical advice for company valuations. When it comes to investing, it's vital to research the company. Look at the financial news and reports to get a sense of the company's performance and market conditions. Calculate the key ratios. You better be using that PE and PB and dividend yields ratios to get a quick snapshot of the company's value. Compare it with peers and use tools and resources. Guys, it's never too early to invest in your financial future. And also, this pie was like actually the most delicious thing ever. I just didn't record myself eating it. Leave your questions in the comments below. Bye!